In today's video, I'm going to be really talking to you about the best stocks right now for your TFSA. So if you're not Canadian, this is definitely just for Canadians. A TFSA is a tax-free savings account, and you can really only put so much money into a TFSA, which is why there is a very important fact of which stocks you should really put in there. So what I'm talking about is basically if you put money into a TFSA, there is a limit on how much you can basically put into that TFSA, which means that any money that you lose in your TFSA, you cannot claim as a loss on your taxes, and with that loss, you also cannot just say, well, I lost $10,000 last year in stock trading. I can put $10,000 more in. That's not how it works. If you take the $10,000 out, you can replace it next year. However, if you lose it inside the TFSA, it's that donation or that part of your allowance to put in there is basically lost forever. So instead of you being able to put in, let's say, $76,000 this year, you would only be able to put in 66 because you lost 10,000 that you put in. So these are all going to be safe stocks that also pay a dividend that have growth. The reason why is because the dividends are now going to be tax-free, and then also the nice part about it is any of the growth is also tax-free. Now, these are also mostly blue chip stocks, so there's no Tesla in here. Let's get down, let's check these out. So I'm going to include some American stocks and some Canadian stocks, but I'm going to tell you right now, if you are buying an American stock because of the dividend, which you wouldn't be here because it's only 0.64. However, if you were buying an American stock for the dividend, do it in an RRSP. The reason why you would want to do that is because with an RRSP, that money that is paid to you when it comes to the dividend is also going to be essentially tax-free when it comes to the American taxes, while in the TFSA, you'll still be taxed on the American side when it comes to the dividend. Now from there, Apple is a fantastic choice. It's very easy to get in and out of because, of course, the average volume is well over 80 million shares traded every single day. Another thing that you can also look at for growth over the past 5 years is the beta. It's based off of a monthly growth or decline, but what you're basically looking at is for every 1 point that the stock market goes up, you're also going to see Apple go up, in this case, by 1.21. So essentially for every 100 points that the stock market goes up, you should be up 121 points. So this would be extremely good. So you're going to get growth with Apple, which is a no-brainer. We all know that. You're going to get a small dividend, which is tax-free on the Canadian side, but on the American side, you will still have that withholding tax, which I think is in the 10 to 15% range as of right now. And, of course, you want to see at least a little bit of a pullback before you buy most stocks, and as of right now, there is around an $8 pullback, so it's looking pretty solid to buy right now. The 5-year chart, and this is what I'm talking about by growth, and of course, most tech stocks right now are trading in a range, which we actually still do see with Apple. However, it still has this growth that we don't see with stocks like Microsoft. We can also see what's starting to look like a potential flag. And of course, if it dips below this point, it's going to go down. If it dips above, it's going to go up. We can also see that it's very, very good with paying its dividend. It does increase its dividend over time, which is what we really want to see. And we also want to see that they are beating quarterly estimates, which they are 4 quarters in a row. And we also want to see them making more money year over year. Of course, 2019 was a tough year, but of course, 2020 was a fantastic year for them. The next stock is Caterpillar. I really like Caterpillar, mainly because of what the US government is currently doing with all of this stimulus that they're trying to put into the economy. They're trying to do a big infrastructure plan, which of course one of the main companies that are going to be behind that big infrastructure plan is Caterpillar. They make all the big trucks, they do all of that, and of course that just seems to me like a perfect company right now. And of course, the beta is not as great. It's at 0.92, which essentially means that for every point that the stock market goes up, this is going to go up 0.92, which is still up higher, but it's not matching the stock market. But you are getting a greater dividend than what you would get if you were just to invest in something like VOO or SPY. Caterpillar's ticker is CAT, cat meow, I guess you could say. My budgie, he says kitty cat meow. I just wanted to let everyone know that it's kind of funny. But average volume is 3.5 million shares traded per day. It's kind of fun to have, really, because when it comes down to it, you're not going to be trading a million shares, and anytime that you're looking at just a ridiculous amount of shares, you're going to be able to get in and out of this stock quite easily. Now, there is some really nice growth that we have had over the past year or so. Of course, we do see a little bit of a downturn, but of course, that's what we've seen with COVID. It was on a slight decrease or downtrend anyways, because of course the previous admin was not really spending a ton on infrastructure, yet they were still doing a lot of good things. But now with Biden, he was really looking to push the infrastructure bill, and of course recently there's been some issues with that bill, and we've been seeing a little bit of a downtick because of that. Could this go any farther down? Yes, I feel like it could go down to this range, but if we start seeing that bill pass, it could go up higher. It did have what looks to be somewhat similar to a double top, which is probably why it also went down. We can also see that there is a nice dividend increase. However, 2020 was not a great year for them, but they are beating analysts' estimates every quarter, which is fantastic. Now we're going over to the Canadian side. Now this is the side that I actually prefer when it comes to the TFSA. I do hold some American stuff in my TFSA, but it's actually through ETFs and not just individual stocks. However, when it comes to individual stocks on my TFSA, I have owned CNR, Canadian National Railway, which is the next stock I'm going to talk about in the past. I don't currently hold it right now, other than through some different ETFs. But what you're looking to have when it comes to stocks on the Canadian side is, again, a very solid company that doesn't have too many years in the past of declines, and something that does pay a dividend, because why not have some kind of income that is, of course, tax-free. So with CNR, we have volume that is 1.5 million shares traded every single day. We have a dividend yield of 1.88%. And its beta is quite low when it comes to growth or any kind of American stock that we were just looking at. However, we are looking at a company that I think could have some great potential coming to them, mainly because with the Canadian government and a lot of the different provinces and different groups of people, they are very, very, very against pipelines. And what basically happens is, if there's no pipelines, oil can't go anywhere. How does oil travel? It's through the trains. And this is where CNR in the past has done really well, is between grain transportation as well as oil transportation, and that's what I think is going to continue, because we're seeing all of these pipelines getting canceled recently. We can see that it tends to really level out for a while, decrease a bit after the leveling out, and then there's usually a push afterwards, and that's probably what's happening right now. It's on a little bit of a decrease, and there might be a push later. Once we start seeing COVID tend to go away, more and more oil companies mining again in the oil sands, I'm going to say that this looks like a potential good growth story in a little while. Not necessarily right now, but maybe give it a few months. I really do like the dividend increases. This is one of the reasons why I invested in this company in the past. And of course, earnings was lower in 2020, but whose wasn't, to be honest. The only thing that I am kind of scared of is the fact that their earnings are going down while their revenue is going up. So either they are reinvesting in their business or they're not. But it does seem like where I live, Canadian National Railway is making a lot of new rail cars, so that could be where a lot of the earnings are going. TD and the banks are, again, another great choice. This is something that if you're a Canadian, you should invest in. And my belief on the banks is just to get the cheapest with the highest dividend, and then you just roll with them for the rest of your life. Mainly because you're going to be paying, or most people are going to be paying, bank fees, so you might as well get that money back. Of course, make sure that you top up your bank account so that you don't have to pay bank fees, because when it comes down to it, usually it's cheaper. For example, myself, I think I'm in like the $30 a month bank account plan thing that they have, and if you hold more than $5,000 in there, then you're able to not have to pay that amount of money. You get a free credit card that saves you another $120 a year and things like that. So overall, it just pays to sometimes have more money in your checking account versus investing it, because if you were to invest $5,000, let's say, or let's say $6,000 at getting a 3% dividend, you are now looking at just, you might as well keep your money in the checking account until you have over that amount so that you don't have to pay those monthly fees. But once that's over, start investing in the banks, because then they can essentially pay you back. But TD does pay a 3.6% dividend, 5 million shares on average. Their beta is 0.88, which is fantastic. And what I really like to look at is the PE ratio. This is what essentially tells you how cheap the stock is. Now, you can only compare, and I'm going to warn you now, you can only compare PE ratios versus other Canadian banks. You can't say, well, this is a cheap stock because Tesla trades at 600 and something PE. No, because Tesla's in a totally different group of stocks. It's a massive growth story. While TD is not a massive growth story, recently it was a growth story, but as of right now, it's not as huge as Tesla, where you're going to be probably 10xing over the next couple of years. TD is not going to be doing that. So from there, what you're looking for with TD is the ability to get some growth that's close to the same as the market with a much higher dividend. You're pretty well sit here. Traded within a range for quite a few years, not going anywhere. Recently, basically everyone has figured out that TD and all of the other Canadian banks are making an arm and a leg. I guess you could say pun intended, because of course now interest rates are low, but they're still really killing each quarter, mainly because of those monthly bank fees that everyone is paying. Of course, they do raise their dividend quite frequently, except for recently, they just can't raise their dividend. They are literally shut out from raising their dividend for the past year. The government's not allowing them, or the so-called watchdog is not allowing them. But I made a video about that, about when I think that they'll raise dividends. However, from there, 4 quarters in a row of fantastic earnings. 2020 wasn't a massively fantastic year, but they did actually make more money while having less revenue, which is, again, fantastic in my opinion. And then CIBC, which is essentially the golden child of my bank or my investing accounts. And again, 11.89. TD's the cheapest PE ratio. CIBC's the second cheapest right now. And you're looking at a 4% dividend, which is really great. The beta on this is actually 1.02, so it's a bit better than the actual stock market itself. And the average volume is 1.5 million shares traded on average. CIBC is the better choice technically if you're looking at the stats right now than TD. And it's almost like if you're a basketball player or coach or somebody who follows basketball and you look at comparing CIBC to TD, you're essentially saying it's like the same as the trade that may happen very soon with the Toronto Raptors and Golden State Warriors, with the Warriors trading James Wiseman and Wiggins to Toronto for Siakam. Siakam would be more like the TD, where it's more established, while with Wiggins as well as Wiseman, they're like CIBC, that they have a bigger dividend because they can get you more scoring. However, at the same time, you're looking at Wiseman being a much bigger future growth because it has the higher beta. So I guess that makes sense if you're a basketball person like myself. Traded sideways for a heck of a long time. Again, recently, pretty much every bank other than National Bank traded sideways. And recently, huge growth. National Bank is another good one, but they're pretty expensive right now when it comes to PE ratio. Again, great dividends. At one point, they were raising their dividends every other quarter, but again, recently they've had to freeze them mainly because of COVID. Great quarterly earnings. They were on a bad downtrend when it comes to 2020, and of course 2019 they made less money on roughly similar revenue. However, I would assume that this is going to be a big turnaround for 2021. This is right now, I'm going to say 2019 and 2020. This is why their PE ratio is lower. They don't seem to have as much growth potential into the future, but you really want to focus on banks as the ones that are not, the big six anyways, that are not in favor right now, because basically what happens is with the Canadian banks, there's 6 of them, there's going to be 2, 3, or 4 of them at a time that are not favored, and the other 2, 3, or 4 are favored. And then it's going to swap and turn around every 2 or 3 years, so you generally want to buy the ones that are not favored, and then they'll have the higher growth in the future. Then you grab the other ones that are not in favor 2 or 3 years from now, and you just keep on building your portfolio that way. That's how I personally do it with the Canadian banks, and I feel like I've been pretty successful with it. Now, I hope that this video has helped you with your investment goals. If it has, hit that like button, subscribe. Of course, never trust a random person on the internet. Always do your own research. I hope that you've enjoyed. I'll see you guys again in my next video.